Welcome back to the Wealth Witches podcast. I'm your host, Katelyn Magnuson. Today, we're talking about a topic that always comes up, honestly, throughout the year, but especially the tail end of the year and Q4 time. So, that is all about, do I need to buy more to save on taxes, or do I need to spend more to pay less in taxes? The answer is always going to be, it depends. And you're like, oh my God, okay, of course it depends, but what does it depend on? So I'm going to give you some examples that we've seen with our clients, and maybe they'll be useful in your life, but regardless, they're going to give you information for you to make more informed decisions. Let's pause for a second here. And I want to talk a little bit about our tax system first in the US. So if you are in the US and you're a business owner, whether you are an S Corp, whether you're a single member LLC, a sole proprietor, a partnership, you are paying taxes on your profits. Now there's some more nuances. If you're an S Corp, you have payroll, etc. But for the sake of this, you're taxed on your profits. And that is income or sales in your business minus expenses. That leaves you with your profit that comes over to your personal return or onto your personal schedules. And then you pay a varying amount of taxes depending on what tax bracket you fall in. Maybe you're a business owner and you have a spouse and your spouse has a day job. You pay a combined, if you're married filing jointly, your incomes get combined together and then it gets compared to the tax rates for that year federally. A lot of people don't understand this. So that's why I wanted to talk about tax brackets first. So for example, let's say that you're in the 24% tax bracket. That doesn't mean that all of your income is getting taxed at 24%. That means everything in the 24% bracket gets taxed at 24%. Everything in the next bracket, the 22% bracket, gets taxed at 22%. Then you go to the 12% bracket. Then you go to the 10% bracket. And so it's only the income in each of those brackets that's getting taxed at that rate. A lot of times I've seen things come up, especially if you're working a day job, but that does play over into being self-employed. Oh, I don't want to make more money, or oh, I don't want to do overtime because that's going to push me into the next tax bracket. And that's thinking that it's a flat tax rate. So if you were to go from the 12% bracket to the 22% bracket, that's a huge jump. It's a 10% jump if it was being applied to all of your income. It's not being applied to all of your income. It's only being applied to that amount in that bracket. So I want you to keep that in the back of your mind. If you want to look up the tax brackets for the year, you can check it with the IRS. Most people will either be single or married filing jointly. There is head of household. Those two are the most common. So be thinking about this in the back of your mind. So you end up in the 22% bracket. That means that you are paying 22% on whatever that amount that you're being assessed tax on. So let's say that you're looking to buy something that's $1,000 for your business. So it would reduce your taxable income by $1,000. If you're in the 22% tax bracket, that means that you're only saving $220, 22%, on that $1,000 purchase. So you're still out of pocket $1,000. And then we're going to say minus the $220 that you saved on taxes, because that's basically the discount that you get on it. And that is $780. So you're still out of pocket, like you've spent $780 to save $220. So in general, one, I don't ever recommend buying for the sake of saving on taxes, but there are some strategic moves for when I would time purchases that are necessary. And that's the whole premise here. So let's say that you're a photographer and you need to upgrade your computer, or you need to upgrade your camera body, or you're looking to buy a course or something, mastermind. Let's say that this year it's been a really, really profitable year for you. Maybe next year you're not planning on it being as profitable, or you don't know how it's going to look yet, but you're not necessarily as sure. So what happens then is it may make more sense for you to make that purchase this year before the end of December if you've made more profit this year and you're in a higher tax bracket. Because in that example, maybe you're in the 24% bracket. So maybe you're saving 24% on that rather than being in the 22% bracket or being in the 12% bracket. Vice versa. Maybe you took leave this year. Maybe you're growing your business and the next year is looking to be significantly more profitable than this year. It may make sense in that case to wait until January 1st or get into the new year to make that purchase in that year when you think you're going to have more profit and therefore a higher tax liability and a higher tax bracket. So it's all about being strategic with your purchases. That's not to say if you need to purchase something, if you are a photographer and your camera breaks and it's your only body, rent one if you aren't able to buy one right away. But that doesn't mean that you're waiting to buy it for 6 months because it breaks in June and you think next year is going to be more profitable. I mean, you do you, make an informed decision. But those are the types of things that I want you thinking about when it comes to how you're spending your money and how you're making purchases. Because without fail, our clients, our tax clients, people on the internet, on TikTok will pop up and like, oh, I need to spend money because I think there's this misconception that there's some magic around how taxes work. And trust me, this podcast is both witches. You're probably here for a little bit of magic. There's not a lot of magic when it comes to taxes. It is pure mathematical calculations. It is A plus B equals C. And that's what we're looking at here. So that's why it gets to be so much simpler. There's not some magical equation that's like, oh, well, if I buy exactly this much, it's going to save me more than I'm spending. There's some things with cars, which we'll get into on another episode, honestly, because it's very, very nuanced. So what you can do, and something that I want you to be thinking about in this example, let's say you're, spending money with B&H Photo or, Apple. That money is going to another company, or maybe it's going to a small business. Maybe you're, buying a mastermind, or you're, paying a bonus to your team. There's all sorts of different ways that you can be spending money that is aligned, that does still help with your taxes. However, I would always rather, in general, when it comes to saving money, it's better for you to keep that $1,000 in the example that we were using earlier and pay $220 in taxes on it, because you still pocket $780 more than if you didn't have that $1,000 or you spent that, $1,000. So be thinking about that, and don't just be spending for the sake of spending. We're spending on necessary things. We're spending on upgrades. We're spending to fix equipment. So all of those are absolutely fine, but we want to pay attention to the timing when we can. Now, my favorite option. Let's say you get to a point, and this is delightful when it happens for the business owners that we work with. You get to a point where you're like, wow, my bills are paid. My business bills are paid. My personal bills are paid. My quarterly estimated taxes have been paid. My, everything's in a good spot. I don't need to upgrade anything. And I have leftover money. It's a delightful problem to have, right? What do I do? And that's a lot of times when clients are like, do I need to spend money? Like, what am I doing? I have this extra money in here. One, you can do nothing. You can pay the taxes on it. You can have additional money. You can take a vacation. You can put it in an emergency fund. But my favorite thing to do with it, if you've gotten all of those things taken care of, is to look at retirement. And we're not going to dive super deep into retirement options. However, think of pre-tax accounts like a SEP IRA, which is the most common for small business owners, followed by a simple IRA if you have employees, or an I-401k if you have a lot of money left over. And this happens a lot when we have clients that don't need to live off of their paycheck. Maybe they have a partner or a spouse or a living situation that they don't need to be, their income is not necessary for their everyday bills. That's one of the only times that I actually recommend looking at an I-401k, because in order to make the most of them, you need to have a fair amount of money available to go to retirement that you don't need for your bills. So for the sake of this example, we're going to use a SEP IRA. And we're going to use the same example that we were talking about before with the $1,000. Now, SEP IRAs are pre-tax, meaning they help you on taxes now. They're a business expense. They're a business retirement account, just like spending something at B&H Photo. Instead of spending $1,000 on a lens, you're putting $1,000 towards your SEP IRA for the year. It has the same impact on your taxes. So you're still out $1,000 and you're saving, in this example, $220. However, that $1,000 goes to future you rather than to B&H or to Apple or to, wherever you're spending the money at. And that still saves you on taxes currently. Now, keep in mind, there are post-tax options, there's Roths, there's, a whole bunch of different things that you can get into. There's taxable brokerage accounts, but that is one of my favorite things for you to do if you're getting to the end of the year. And the best part about a SEP IRA, you can contribute until you file your business taxes. And for some of you that are a sole proprietor or a single member LLC, That's potentially April 15th. For some of you that are an S Corp or a partnership, that's probably March 15th. And you have until, even if you extend your taxes, you have until the extended deadline. So September 15th to contribute for the prior year. So in this example, if you're contributing for 2025, you have until you file your taxes in 2026 to contribute to a SEP IRA. Tons of flexibility. Now, can you also get it set up and be contributing $100, $200, $500 every month? Absolutely. But you can either do a one-time contribution or you can do a top-up before you file your taxes. And we do this with a ton of our clients that have a SEP IRA, but they may not know how much they can contribute during the year because they don't know what their tax liability is going to be, right? And so like maybe they have $20,000, and if their tax bill is $20,000, then they don't have anything to go to their SEP. But if their tax bill is $12,000, then hey, they can, put $8,000 into their SEP. And you have to pay attention. If you have a salary, you can only put up to 25% of your W-2. Like if you're an S Corp and you pay yourself $60,000 a year, you're capped at $15,000 for that SEP contribution. If you are a single member LLC or a sole proprietor, you're capped, I believe, at 25% of your net profit. So be working with an accountant for sure, even if it's just a consult, once a year. Hey, how do I look at this? What is this number? Where do I need to be paying attention? So you're not over contributing. And then again, it is a tax write-off. It's deductible for you on your 1120S if you're an S Corp, and in your, within your Schedule C, there's some additional forms in there if you're a sole proprietor or a single member LLC. So that is one of my favorites because it gives so much flexibility. And you can literally sit here, like we'll do it for clients if we know that they have a SEP they want to contribute. We'll get everything all ready in March and we'll say, hey, if you put nothing into your SEP, this is what your tax bill looks like. If you put half of what you're eligible for, this is what it looks like. This is your total cash out of pocket. And if you max out your SEP, this is your total cash out of pocket. And then we can do numbers in between, but that lets them make an informed decision and contribute to their SEP and put money towards future self. So something that I highly encourage you to be thinking about if you haven't already. If you get to the end of the year and you don't need to buy, a bunch of things for your business, you're in a good spot, your personal finances are looking really good, paying towards future you is so important. And it's such a good way for you to still get a really great tax write-off. So I'd love to hear if you want to comment on Instagram or leave a review on the podcast. I would absolutely love to know if you have a SEP IRA or if you have more questions about them for future episodes.
That's a wrap for this episode of the Wealth Witches podcast. I hope our magical money talks have left you feeling empowered and inspired. Remember, wealth isn't just about dollars in the bank, it's about abundance and financial freedom in all aspects of your life. I'm Katelyn Magnuson, encouraging you to keep challenging the status quo and embrace your inner witch on this financial journey. Until next time, stay magical.